My name is Joe Perez. I am the content marketer here at NJMEP. Today, I have the pleasure of introducing our partners at Withum, who will be leading an important discussion on the One Big Beautiful Bill Act, specifically what it means for manufacturers now and the steps you guys should be thinking about moving forward. Withum is a forward-thinking, technology-driven advisory and accounting firm committed to helping clients be more profitable and productive in the modern business landscape. Founded in 1974 with headquarters in Princeton, New Jersey, the firm has offices in major cities and financial centers across the country. Withum is proud to have manufacturing, distribution, and logistic clients across the state of New Jersey and throughout the country. Whether you're a middle market manufacturer or a fast-growing startup, Withum has decades of experience with companies of all sizes. I want to thank Withum today and the team for putting together the webinar. And if you have any questions throughout the session, please feel free to raise your hand as Lynn will be there to answer your question. And without wasting any more time, I'd like to welcome Lynn Mucenski-Keck, partner and federal tax policy lead at Withum. We'll take it from here.
Thanks so much, Joe. So I'm going to share my screen. So give me 1 second for this. Should hopefully work as we just tested this. So, and we're going to start at the very beginning. We are so excited to be with you today. Withum is a big believer in obviously the manufacturing sector and the importance it is to economies, obviously in New Jersey, but around the world. So my name, as previously said, is Lynn Mucenski-Keck. I am the federal tax policy lead at Withum, which means I do a lot of work when potential tax bills are in play. So it was a busy July, obviously, and before that and after that, as we're still talking about it. I really want to emphasize to everybody, I'm more than happy to gear this towards what you have specific questions on. I have put together a slide deck. Some of these things you say, Lynn, we know this, let's go to something new or different. Happy to do that. So please make sure you're asking questions in the comments or you're raising your hand. Joe will let me know, and we can talk about it live. So I think that's sometimes the best interaction, because if you have a question or a thought, most likely others do on the call as well. So we're going to talk about the OBBA, or the One Big Beautiful Bill, Act, etc. You can call it what you will. It was passed on July 4th, obviously, of 2025. And there was a lot of changes, and there was a lot of changes specific, hopefully, to manufacturing. And so you may recall, under the previous Tax Cut and Jobs Act, we had bonus depreciation, which was at 100%, but it started sunsetting. So it started going to 80%, 60%, and eventually would have been 40% for the 2025 taxable year. And the One Big Beautiful Bill said, nope, we're going to revert back to 100%. And we're going to say that reversion back to 100% is for qualified property acquired after January 19th of 2025. So you might sit there and say, why didn't we just make it as of January 1st? It had to do with when, President Trump was inaugurated. But essentially what that means is you might be going through your audits or your tax provisions currently, and you see people asking questions, particularly if it's a large piece of equipment placed in service, about when you acquired the property. Because it's not necessarily, you signed a contract, you acquired it in December, but you didn't place it in service until the end of January. That would not automatically be considered for bonus depreciation, because they're looking at that terminology, acquisition date. And so what does the acquisition date mean? Very similar guidance has come out and said, similar to previous guidance provided under bonus depreciation, they're going to review contracts and look for, did you have a binding written contract? Did you enter into a contract? Was it enforceable under state law? And were there cancellation periods? Were there contingency clauses? And essentially, if you had a binding written contract prior to January 20th, even if you placed your asset into service after January 20th, you most likely will not be able to take advantage of the 100% bonus depreciation. I will say you probably, or if you have not, you will be experiencing, there's a lot of deductions potentially rolling through this year on your tax return, which is great, right? But we all know, whether you are a pass-through entity, meaning your income or loss flows to partners or S corporation shareholders, or if you're a C corporation, the ability, in previous years, we used to say, okay, take it all now, drive the NOL, and we can bring the NOL forward, and it could in the past offset 100% of your taxable income. That is no longer the case. So now we're under this regime that says, okay, well, if I this year put all my expenditures to the bottom line and create this huge taxable loss, I'm going to bring my NOL forward, but it can only offset 80% of my taxable income. So I'm always going to have a 20% taxable income, creating a tax liability. So it's really important, unlike years in past, that we're matching dollar for dollar. That if I have $1 of taxable income, I have the deduction in that year, and we're not therefore limiting it, the ability to take the deduction in the future, to 80%. One of the ways that they definitely, under the OBBBA, recognize that not everyone might want bonus depreciation, or maybe didn't plan on bonus depreciation for 2025 because the bill wasn't passed until July. They said, you know what, if you don't want bonus depreciation, your only alternative shouldn't be have to elect out and do makers. We'll still allow you, just for the 2025 taxable year, to take a 40%, which was the planned bonus depreciation before the bill. So I think that that's a nice mechanism. If you're all these other things that we're going to talk about, 163J limitations, 174 immediate expensing previously capitalized, if all those things are driving you negative, this is an approach that could slow your negative down, so you're not limited going forward. The other thing I would point out, a lot of people, and it's true, they say in the regulations and in the guidance provided that certain components of large self-constructed property could be separated, right, from a binding written contract and be deemed as acquired after the date, so they could have 100% bonus depreciation. The problem with that is there's little guidance on this process. So it's out there. It's potential planning idea. If you're one of those companies who said, well, I had a self-constructed project that I was working on, it was binding prior to January 19th, but there was this big piece of machinery that I didn't, necessarily, I would separate and say that I acquired that later. So only thing we say, because there's not as much guidance as we would like, to proceed cautiously when analyzing that. The other major item that kind of goes hand in hand with what we're seeing in New Jersey, with what New Jersey's state and local incentives program are trying to do, are obviously our capital investments, right? And New Jersey adds employment, right? Which makes sense. We want people to be making capital investments in manufacturing in New Jersey, and we want them to be increasing employment. So here, that's the New Jersey side, and we'll talk about that in a bit. On the federal side, they say we are trying to also encourage this. So the first time I believe in history, or at least as long as I've been practicing, I can confidently say we have never been able to say we're going to be able to deduct creation, right, of non-residential real property, commercial property, manufacturing property, right? We're going to build it. And they're going to say, okay, well, the portion that relates to manufacturing, production, or refining, you're allowed to completely take in year one, as opposed to spreading it over 39 years. So that's a big item. And so a lot of people are trying to understand, how can I pair this potentially with the New Jersey credit, potentially with, we'll talk about in a bit, qualified opportunity zones were extended as well, so that I'm benefiting both from a federal and state perspective on these new builds. So again, it's limited to if you're manufacturing something, producing agricultural or chemical items, or refining qualified products. And again, it's similar to what we hear a lot. You can't say you're manufacturing, which you all know, if you're just taking, a bike, for the lack of a better example, and just screwing one screw in it and sending it off its way, right? There's got to be a substantial transformation. I think you all know what that means. There has to be like a material work done on the product to say that we indeed were manufacturing it. So this is a big item that people are trying to plan with those other items I talked about earlier. So one of the common misnomers that I get a lot is, oh, well, it has to be a brand new build, right? And we're not interested in a brand new build. Like, we might buy something and then renovate it, but we're not going to build from brand new. And I would say that you're still in this area, the qualified production facilities. allow both new and acquired property. Common requirements, obviously, for both is it's got to be used, like we just talked about in production. It's in the U.S. or any possession of the U.S. And then essentially your construction, if it's new, has to begin after January 19th of 2025 and before January 1st of 2029. But you also could acquire something after January 19th of 2025 and before January 1st of 2029. So a lot of people were excited when they saw this. We had multiple calls come in and say, hey, we're placing this new production facility in service this year, right? Can I qualify for this? And it probably would be hard to say that your construction began after January 19th if you were saying, like, in August we placed something into service, for example, after the bill passed. So those dates are meaningful, and it's really, though, a future planning technique that we're working with a lot of clients on. It does, obviously, the facility has to be put in service before January 1st of 2031. There's exceptions if you're in a federally declared disaster area, et cetera, et cetera. So still, plenty of time or extensions if needed, potentially. The biggest piece about the used facility is that the property could not have been used in a qualified production activity by any person between January 1st of 2021 and May 12th of 2025. So essentially what that's saying to you is they're not looking for you to go out and buy a previously manufacturing facility and retrofit it or renovate it. They're looking you to go buy a facility that wasn't used for manufacturing, right? Because again, we're trying to stimulate manufacturing. And essentially you're now turning it into a manufacturing facility. So this has gathered a lot of questions. IRS notice just came out in the last month or so on this. Not too many surprises with that guidance, but definitely something that's been talked about. I loved the video earlier when you were talking with your new governor saying, New Jersey is focused on manufacturing and we have had manufacturing growth. I think that also is shown through some of the ways that they are accepting or denying some of the changes at the federal law. So everyone should be aware, just because I said this is happening at the federal law perspective, right? When we file our federal returns, those things called 1120s, 1065s, 1120Ss, New Jersey has the right to say, well, that's a federal law. We're not conforming or we're not agreeing with that federal law. So New Jersey and many states, I will say, historically do not follow bonus depreciation. So that's pretty common that we would expect that, yes, we can take that bonus depreciation at 100% for this 7-year property, but for New Jersey, I have to really depreciate it over 7 years. So there's a little adjustment. But what's really amazing, in my opinion, is New Jersey said, yes, we're still not going to follow bonus depreciation, but we are going to conform with the qualified production property, which is that immediate expensing of that building, of that manufacturing facility. And so not only will you get to look at and allocate costs related to the manufacturing of your plant and immediately expense them for U.S. federal income taxes, but New Jersey is allowing that as well. And I think that really does reinstate or reaffirm their commitment to manufacturing. The other big item is what caused many a headache, trust me, and met much shock in 2022 when no one ever thought that the Internal Revenue Code that provided that you no longer could deduct your research and experimental expenditures, what we call R&E, would actually phase in. But it did, and it was a very painful 3 years, 2022, 2023, and 2024. And essentially what happens is if you're taking an R&D credit, I would say 99% of the time, those qualified research expenditures are acting as a base to say, well, then you have 174 R&E. And now we are so used to the previous years where that was an immediate deduction. We didn't really care. And essentially they said, no, if it's done in the US, you have to now take it over a 5-year period. And if it's done outside the US, you have to take it over a 15-year period. The one thing I would point out to you as manufacturers, knowing that you're multi-state and potentially global, please be aware that the changes made by the OBBBA were only related to domestic R&E. So to the extent that you have foreign research still occurring, that's still going to be subject to a 15-year amortization period. But essentially, the OBBA came in and they said they heard you. They heard you. They heard, New Jersey manufacturers. They heard the National Manufacturing Association say, this is killing investment in the United States, right? When we look at our competitors, i.e., China, they allow a super deduction, right? So they don't even say you paid $1 for R&D and you're allowed a dollar deduction. They say you paid $1 for R&E and we're going to give you a $1.50 deduction or 150%, or in some cases, in some countries, even 200%. And so they heard you and they said, yep, this is not something that we should be doing if we want to stay competitive, right? We still need to allow those expenditures to be immediately deductible. So essentially, the OBBA did provide that option. That yes, now again, there's a new code section called 174 Cap A that says you are allowed to immediately deduct your domestic R&E that you're incurring in your 2025 year. So that's another big item that maybe now all of a sudden is causing a deduction. I often caution, probably not so much in manufacturing, but definitely in startups, definitely in pharma. People will say, well, I don't want that to be an immediate deduction for what you talked about before, Lynn. You said I'm going to be limited to 80% if I create an NOL and it moves forward. So me taking it all this year isn't beneficial. There still are two other options. One option is to say, well, I'm going to capitalize and amortize my 2025 R&E expenditures over 60 months. And that 60 months doesn't start until when the benefit of the R&E is first realized. So yes, you're capitalizing it, but if you don't realize that benefit for 4 years, then you're not starting that 60-month period for 4 years. The third option is what we refer to as a 59E election, which essentially says you can start it as soon as you capitalize it, but you're taking it over a 10-year span. Something that I think, potential planning activity, if you're in this sector, is you can pick and choose. It's not an all or nothing, right? I can have multiple different R&E projects, and I could say, well, this one I want to immediately deduct, and this one I want to capitalize, or vice versa. So that's one thing that I think a lot of people miss, is you have selection even within the taxable year based on the projects you're doing, which method you want to apply. One of the biggest items that's driving huge deductions in the 2025 taxable year has to do with, remember in 22, 23, and 24, we had a capitalized domestic R&E over 5 years. And oftentimes that meant we only got 6 months, right? It related due to the application of the code, 6 months related to 2022, and then 6 months related to our 2023, et cetera. And then it continued. But at the end of 24, we had a capitalized amount sitting on our balance sheet that was just sitting there. And what the IRS has come through is what we call transition rules. And the transition rule, there was some exceptions for small business, but that kind of ability to deal with that in the 2024 tax return has passed. So we're just going to focus on what can I do now if I haven't done anything. Well, you can do nothing. And you can say, well, I'm just going to continue the R&E capitalization over 5 years. It works for me. It's working for what we're trying to do. I'm done. But what we're seeing a lot of companies do is they're saying, okay, well, now that capitalized amount that's on my balance sheet as of 1/1/2025, I can immediately deduct it in the 2025 taxable year. And that's the capitalized amount that remains from 22, 23, and 24. Or I can spread it and I can say I'm immediately going to deduct it ratably, half in the 2025 taxable year and half in the 2026 taxable year. Again, similar to bonus depreciation, they're trying to level out your expenses for you if you choose to do so, which is why modeling is really important, and essentially say, we're not going to force you to have all these expenditures in 1 year. And so there's an ability to kind of pick and choose your levers to get to the right spot. The one item that I think is pretty clear now, but at the beginning was not, is make sure that that amortization, if you do decide to say, I'm going to fully deduct it in the 2025 or spread it in 2025, 2026, that's amortization. And that's an amortization add back for interest expense purposes. So what we're seeing a lot of in 2025 is, we might have had disallowed interest in previous years, but all of a sudden, now we're taking that capitalized balance of amortization and immediately expensing it in the 2025 taxable year. And that's an add back for me for purposes of freeing up some disallowed interest expense from the past. So that's a nice benefit that correlates with this type of adjustment.
Sorry to
Um,
interrupt, Lynn. Just one
yes,
second. Just to answer a question in the chat, recording of the webinar will be made available within a week to everybody in this who participated in the webinar, as well as, we encourage everybody to ask questions. If you have any specific questions, Lynn is here for you. That's it. Thank
okay,
you.
absolutely. Bring your questions in. Again, you'll see support from the state of New Jersey saying to the extent that there was New Jersey um, research and development expenditures performed in New Jersey, we too will allow you to, follow the federal treatment that's been provided. So again, another support for manufacturing through New Jersey's conformity. Two items, one currently and one prospectively, I'd like to inform you about the interest expense deduction limitation. So we all were aware, right, that when it was a limitation, we said, okay, what's the amount of interest expense that I'm allowed to deduct? And under more restrictive rules, we were saying, okay, it's 30% of EBIT. It's called something else, tentative taxable income, but it's equivalent to EBIT, right? Pretty much. And so at that point in time, that reduced, right, this dollar amount you're applying the 30% to by depreciation and amortization. So it really lessened the amount of interest expense you could take. Going forward, right, we said for the 2025 tax year, they essentially said, nope, you can now calculate your 163J based on EBITDA, which means, all that depreciation, amortization that you're incurring for building plants, right? For hiring more people, for expanding, right? You would probably need to leverage it. You should still be able to deduct the interest expense to that, even if you're pushing that depreciation through qualified production property immediate expensing or through a bonus depreciation. So that is a blessing, obviously, for manufacturers. One of the items I would point out is something that had been a hot debate in the industry, and this is you. I'm happy to take it offline and have these discussions. But you saw some firms coming up with a position where they said, well, we're not going to say that it's interest expense for the trade or business. We're going to say that it's interest expense that we're capitalizing up and into our inventory, and therefore it's not subject to interest expense limitation. So Congress came out in this bill and made it very clear that if you have interest expense that you've been capitalizing into your inventory and have not been limiting it under 163J, that is no longer allowed. The expectation is that the 163J limitation will apply to your interest expense that you're putting into inventory, as well as the interest expense that's falling below the line. So those are items to watch out for. You might have heard it called a 266 position. We were taking a 266 position. So that's phased out under phased out under the OBBBA. The other item for future purposes, right? Because we're already into 2026. If you're a C corporation, you were used to saying, okay, I am only allowed a charitable deduction up to 10% of my taxable income. Well, both for individuals and corporations, for 2026, you're going to see a floor. So what that means is you have to exceed a certain amount before you can even get the deduction. So let's just start with an example of a C corporation. So they say C corporation's charitable contribution must exceed 1% and be less than 10% of the taxpayer's taxable income in order for you to be able to get the deduction. So if you have taxable income of 100,000, you would say, well, 10% of that would be 10,000. So what happens? I make a $10,000 deduction, right? Or contribution. They're going to disallow that first 1,000, right? So even though I made 10,000, the amount I could deduct in my example would only be 9 because I have to exceed that 1% before the deduction comes in play. This same application occurs to individuals as well for the 2026 taxable year. However, they must exceed 0.5%. So if you were working with your team and you were working with your financial planners, et cetera, you might have seen a large push last year, right, to bring in charitable contributions, charitable deductions earlier because I didn't want to have to deal with that floor disallowing any of it. So there was a lot of planning regarding that at year end. Um, State and local tax deductions, PTET, New Jersey bait, whatever you might want to call it. These are all kind of intertwined. New Jersey senators and or representatives as well were big holdouts, along with New York and California, to say they would not sign the OBBA unless this state and local tax deduction cap was increased. And they did. They had to agree to increase it because they were holdouts, and the negotiation worked, right? And so under old law, what they used to say is all your state and local income taxes, you can add them up all together, but if they exceed $10,000, that's the maximum amount you can take on your itemized deduction for individual income tax purposes. And when you saw that, it hit a lot of East and West Coast states more because they pay more taxes, right? They pay more state taxes, they pay more real property taxes, et cetera, et cetera. And so at that point in time, when the 10,000 SALT cap came into play under the Tax Cut and Jobs Act, you saw states come in and be creative. And a lot of people saying, let's form this pass-through entity tax, or New Jersey bait. And so what the New Jersey bait allows you to do is, if you're in a flow-through entity like a partnership or an S corp, is they say the partnership or the S corp is going to pay, right, essentially your state liability, and then you're going to receive a credit for what that partnership or S corporation paid. That is not subject to the $10,000 SALT cap. So that was the workaround. Well, starting right in the current year, now they're saying, well, that SALT cap isn't $10,000 anymore; it's 40. So we've had some people say, okay, well, I'm not going to bother, or should I bother doing the New Jersey beta election anymore? Or it's up to 40. I'll just take the 40 and run. So what we like to remind people of is, I would say, in most cases, don't take the 40 and run. It's important for you to understand that, yes, I still can take, right? My state and local income taxes might come up, obviously, through my PTIT, right? Because they're paying the tax on my partnership or S corporation income. But I can still use my real estate taxes, my school and county taxes, et cetera, for the 40, right? So it's still potentially most likely a better position. For our high net worth individuals, right? You got to remember that to the extent that you're putting any of the taxes on your Schedule A or itemized deduction, that's an add back for AMT purposes. If I pay it through essentially the New Jersey bait program, that's not an add back for AMT purposes because it's taken above the line for purposes of the calculation. So there's a lot of implications to this. It could work for some people. I'm not saying it is a welcome change for people who don't own partnerships or S corporations, right? And just weren't getting that benefit. But I wouldn't say it's a direct kick to stopping pass-through entity tax regimes or things like New Jersey bait. Things you should be aware of: the $40,000 does phase out. It starts to phase out for people with modified adjusted gross income if you're married for $500, if you're single for $250, but it can't be reduced below $10,000. So they're not going to penalize you to say, okay, we're going to give you zero now. They're just saying we'll phase you out until you're at 10,000, and then we will go no lower. So that's just kind of an update of what's going on in your state and local tax area. The other big item that came out, as you know, no tax on tips, no tax on overtime, was a big I'm trying to think of the proper wording. President Trump, when he was lobbying, right, when he was running for president, it was a big tagline in his campaign, and he delivered. And so when that was delivered, I will say for the 2025 taxable year, employers were exempt from having to help make that happen. In other words, put something specifically down in a box on their W-2 wages or report that to the taxpayers. Why? Well, because the law wasn't passed until July and nobody had been tracking that information yet. Now, going forward in 2026, as an employer, you are going to be required to track that information. And so essentially, things, top items I always like to remind clients about is, please remember, this only applies to non-exempt employees who work over 40 hours a week. So oftentimes we get questions of, well, in my state, in California or in Ohio, this means overtime. They're not looking at that definition. They're looking at the federal law's definition. And that's the definition that we are tying this code section to. Only the premium portion of overtime. So if I say you've worked 40 hours and now you're working an additional 5 hours, we're going to say, okay, it's not all the wages related to the 5 hours that are going to be susceptible to potentially relief for non-taxation for overtime. It's only the additional half, right? So it's the premium portion of overtime. The other item that I also, I think employers know, but it's important for employers to be reporting on, right? When you're looking at the total benefit that you're providing your employees, that does not reduce the responsibility to pay payroll taxes or Social Security and Medicare, right? So they're still going to have to pay, and the employer is still going to have to pay, even if the overtime income it finds out to be exempt for purposes of determining federal income tax. One of the items I also point out, a little like the TCJA, in that it sunsets, right? So anything that we see sunsetting, we need to be aware, like, that's going to be a conversation come 2028, right? Or 2027 about, should that be sunsetting? So what's the amount they can exempt? 12,500 if you're single, 25,000 if you're a joint. It does start to phase out. And in 2026, employers will be responsible, which includes responsibly reporting on box 12 of the W-2 reporting. They're going to put a code TT for the amount of the overtime compensation that is calculated, that premium amount. And also, they're going to be asking you to identify the employee's occupation, because as I should have started with that, the only time you can exclude the overtime compensation is provided they're in the designated list that the Treasury has provided. So just compliance for you there. That's something that hopefully your systems, whether you use ADP or payroll, they're helping you track that. But that is going to be something you're going to be responsible to report. Okay, I'm going to stop and just flip over to see if there's any questions. Is there anything? Nope, I don't see anything. Okay. All right, guys, really, it's an open field. You can ask me any questions. So if you have anything OBBA related, don't be afraid to ask. The one thing that I always like to point out is, while the OBBA did remove a fair amount of personal clean energy items, for example, the commercial vehicle credit, the personal vehicle credit, right? For home residential property credits, et cetera. A lot of the clean energy provisions still exist for businesses. And why I say that is, there was one provision called the commercial clean vehicle credit, which was phased out. And the charging station credit is also being phased out, but there's still a lot of credits out there that, especially in manufacturing, you're seeing people get involved in. So when you think about, my total plan, I'm thinking maybe I will build a manufacturing, or I will retrofit an existing building for manufacturing. You can get, immediate expensing for federal purposes. New Jersey will follow that expensing. Then there's discussion about that we're going to get to a New Jersey tax credit for that expensing. Then, to the extent I make it with clean energy, think geothermal. I know a lot of people like geothermal, solar, battery storage, et cetera. That also is going to generate you a federal credit. And for startups, I would say, or for people who say, well, I have all this credit and I can't utilize them. Maybe I don't have that much tax that I'm paying because I just took 100% of depreciation on my qualified production property or my equipment. I say, yes, but these credits, for the first time in history, can be sold. And that is a huge market. So we're going to talk about that next. So the most common in the manufacturing industry that I see from a clean energy perspective is 48E, which is the Clean Energy Investment Tax Credit. It was 48. It switched over to 48E. Those are the things I just talked about: solar, and in addition, battery storage. You'll also see that those geothermals were never sunset under 48. So geothermal can go under 48. And let me tell you, there are new rules under 48E that do not apply to Code Section 48 or do not apply to geothermal, which is very helpful, right, in making it an easier process to claim that credit. 45X, Advanced Manufacturing Production Credits. If you are working with critical minerals, right, manufacturing critical minerals, we're dealing a lot with battery cell and battery production. So there's, if you're making pieces of solar panels, right, these are all things where if you're manufacturing those items, you will indeed be able to claim a 45X credit. And that credit is dependent on what you're manufacturing, and it kicks in as soon as it's sold to a third party. And there's potential for it to be recognized if you're selling it to a related party who then on-sells it to a third party. So those are some significant credits. You'll also see what we know as the 45Y credit, which is if you're actually in the process of production, right? So I'm going to produce clean energy. I'm going to sell it to the grid. That is something as well. But usually in the manufacturing space, you're seeing people actually manufacture products that are helping clean energy, or you're seeing them put in potential clean energy projects because of savings. When you look at some of the struggles that manufacturers are facing, it's finding energy, right? It's finding and reasonably priced energy. So if you haven't investigated this, it's worth an investigation. What you'll see is we've seen many of our clients in New Jersey, build these things, use what they need currently in their systems, but then if they have more to sell to the grid, then they're now seeing a reduction in their electrical bills where they're using where they're selling to the grid. So this is it's a new area, I know, for most. These particular provisions were really brought through in the IRA, or the Inflation Reduction Act, that was passed under President Biden. But these are still well in play. So if that's part of your thinking, definitely something to make sure you're also quantifying the benefit. When you're thinking about these credits, I would say for 48E, they can be significant, right? So they could start at 30%. So every dollar you invest, you're going to receive 30 cents back from the federal tax government. Ultimately, that tax credit can go to 60%, where you normally see it falling as 40%, but it could potentially go to 50% as well. So it goes up based on what we call adders. So one, am I specifically in an energy community as identified where the government is saying we want clean energy in this space, and so we will give you not 30%, but 40%. The other item has to do with domestic content. Another item has to do with low-income communities. So there's a variety of percentages, but I would say minimum 30, maximum 60, you're more likely to see around the 40%. The other big item I'm going to bring up here that we're doing work for, and I would say primarily for C corporations, is essentially purchasing clean energy credits so to reduce my federal tax liability. So you might say, reduce my federal tax liability. It doesn't reduce your federal tax liability, but you're buying credits for a discounted amount. So I'm going to give an easy example before we look at what this could mean. Say that I have quarterly estimated tax payments, or let's just say my total tax liability is 100. We're going to keep it simple. And we're going to say, the first thing I'm going to tell you is if you're a C corporation, 25% of that liability has to be a cash payment. When you talk about R&D credits, when you talk about clean energy credits, even purchasing clean energy credits, they can only offset up to 75% of your liability. So I'm going to say, okay, well, 25 is cash. I have 75 left. And then I'm going to say, okay, of the 75 left, what if I tell you that I can go buy you a credit to offset that $75, but instead of you paying dollar for dollar for that credit, right? So instead of you paying $75, you're going to get a discount of 10%, right? So now you're down to not great numbers I picked, but 68, $67 dollars to buy that $75 credit. That's a huge cash impact, right? And that cash impact, or that discount in savings, just grows based on how big the liability is. So here is just a quick example, just to show you one of the other beauties about buying clean energy credits is the IRS has said, to the extent that you have intention to buy the clean energy credit, and you do, you don't have to make your estimated income tax payments. Instead, you can say, no, I'm buying clean energy credits. So now not only am I getting the discount on the purchase, which was that 10% I gave you in my example, but I'm getting interest on the float. So normally I would have had to pay the federal government on June 15th. And now I'm saying I'm not going to pay that estimated tax payment because I'm going to say that I have intention to buy clean energy credits, and that cash is going to stay in the company. And maybe I don't buy those clean energy credits until the end of December, or even we're working on 2025 credits now, right? Currently, I would say they're kind of drying up at this point, but they're still out there. And so overall, this is just a high level summary to say this was an example where they had approximately a $27 million liability. They had an overpayment from last year that covered their first quarter payment. So we said, okay, that's going to be that 25% that has to be paid in cash. And then essentially what they did is they worked through to purchase a credit. And based on that credit and the discount that they received, they only received a 7% discount. They were able to save $1.4 million over the year flat. And then they were able to earn interest of around $205,000 on being able to delay those payments for their clean energy credit. So I think people were interested in this. Then they were concerned when President Trump came in because he was a lot about banning everything regarding clean energy. So you kind of saw a lull until we had the OBBA. With things maybe reducing in interest because they wanted to see what was happening. It is picked backed up right now. It's a multi-billion-dollar industry. It is reviewed, blessed by the IRS, and it also helps with effective tax rates if you are in a provision. But it also helps with if you have a foreign parent. It helps them with their IFRS reporting for clean energy and sustainability. So definitely something to keep on your radar or ask questions about if you haven't heard. Now I just want to bring out, which I'm sure many of you are aware because we're talking New Jersey manufacturing, but there are some incentives, right? Obviously from New Jersey saying, we want you to make capital investments into New Jersey. We saw the video, great video, right? To tell us we have increased capital investment. We have increased employment in New Jersey related to manufacturing. So starting in September of 25th of 2025, and it runs until the funds are exhausted, or March 1st of 2029. So we are very much like in that window. You are going to be allowed to receive, right, up to $150 million per project in refundable transferable tax credits. So what is that? How do I know how much it would be? The credit equals the lowest of 0.1% times capital investment times number of new jobs. The slide's a little wonky. Or 25% of total capital investment. And the maximum you can go after is $150 million. I would point out that we just talked about 45X and clean energy manufacturing, like battery cells, battery metals, critical minerals, solar products. They also have a similar designated fund out of the New Jersey Manufacturing Tax Credit Program, where they're reserving $100 million for clean energy manufacturers. So that's still in play because it's in the first 2 years. I would point out for this particular credit, you do have to have a minimum of $10 million of capital investment. So it is significant. And you have to be able to prove that you're going to create at least 20 new full-time jobs. And then the facility must be primarily engaged in manufacturing, which they quantify as greater than 50%. So target areas we're seeing, looking at this manufacturing credit, obviously advanced manufacturing, non-retail food and beverage, defense, clean energy, and life sciences is where we're seeing a lot of interest for this particular credit in New Jersey. It should be noted that this is only really for C corporations, so this credit doesn't help pass-through entities or individuals, right? The other item I would note of this credit is you can sell these credits, and the credit, you can't sell them for less than 85 cents on the dollar. So even if you say, well, I'm going to get this credit, but I'm not going to have this New Jersey liability because I'm going to probably take that qualified production property and immediately expense and have a big negative that year, I would say yes, but you can also sell the credit. So New Jersey is trying with obviously how they're forming to the OBBA, but also how they're trying to incentivize manufacturers to come to the state. And this is one of those items that clearly reflects that. Okay. I still don't think we've heard any questions, but again, unmute yourself, ask in the chat. We're here for you. I really wanted to touch upon because it hasn't been as front and center because we're still kind of dealing with the old qualified opportunity zone regime. But in the OBBA, they made a newer and better qualified opportunity zone regime. So a couple things that I would highlight. If you're in the qualified opportunity zone regime, let's first talk about what it was. So essentially what they said is if you were triggering long-term cap gain or capital gain, they were saying they allowed at the federal level to say you could not pay tax on that gain, right? These capital gains, if you invest it in a qualified opportunity zone trader business or qualified opportunity fund within 180 days. So you might say, well, what's a qualified opportunity zone? Qualified opportunity zones were places where the states designate where they think they would like investment to go, usually related to a variety of factors, including income, employment, et cetera, et cetera. Essentially what they said then at that point in time is that to the extent that you deferred, right, you invested within the 180-day period, they then said if you hold it for 5 years, we're going to essentially reduce the gain you would have to recognize by 10%. If you own it for 7 years, we're going to up that to 15%. So essentially, what they were doing is they did that by raising your basis, right? They said, I'm gonna essentially act as if you have 10% more basis than you do, act if you have more 15% basis than you do. And ultimately, if you are involved in a qualified opportunity zone or fund related to the old regime, you are plenty aware that there's a mandatory event happening this year in 2026. So if I'm involved in a qualified opportunity fund or a qualified opportunity zone, they have allowed you this deferral, but they said you must recognize the gain no later than the time in which you dispose of it. But you said, well, I didn't dispose of it because I've been holding onto it and it's part of my manufacturing program or it's part of our investment. And in 2026, they say, or you have to recognize the gain in 2026. So we've had clients coming to us now saying, what are our planning strategies? I have to recognize $60 million in the 2026 taxable year. What can I do? Right. And then they say you can, after you recognize that gain, if you hold it for at least 10 years, there's no tax due on the capital gains from the sale of the interest. So this is all part of the current plan. And it was a good plan. But you might have heard, as many have, that some of the areas that were deemed qualified opportunity zones seemed a little awkward, right? And that mainly had to do with the fact that they were abutting an eligible census tract. So when you looked at certain things in Brooklyn being a qualified opportunity zone, that was confusing, right? There's multi-million homes there. Why is this a qualified opportunity zone? Well, it happens to abut a zone or a census tract that would be considered a qualified opportunity zone. They have removed your ability, for the most part, for you to look at the land that abuts a qualified opportunity zone. But let's talk about what they're saying. So this is going to be a rolling forward program. So there is no mandatory recognition date. And as previously noted on the previous slide, any qualified opportunity zone that you are invested in does have to be sold by December 31st of 2047. So there's a mandatory exit date. Under the new law, there isn't. So essentially what they're saying is after this year, right, if you trigger capital gain, so again, something to consider, like, are you going to have a lot of capital gain that you're going to trigger that might go into one of these funds? Well, do I want to be part of this new qualified opportunity zone opportunity, lack of better words, and should I essentially defer that gain to be recognized until 2027? Question one. Then they're saying you can invest, right? If you invest in a qualified opportunity zone and you hold that for 5 years, they're going to increase your basis, right? Eliminate a portion of your gain by 10%. So before it was 10% for 5, another 5% for 7 years. Now they're saying it's just 10%. We can't get above that. But the other big piece that is new is they're targeting qualified rural opportunity funds. And so for a qualified rural opportunity fund, they're saying, you know what, it's not going to be a 10% if you hold it for 5 years. We're going to increase your basis and therefore reduce your gain by 30%. Okay, so that's a big item. Then after 10 years, they're going to increase the basis to fair market value for property sold or exchange, provided it's been held for at least 10 years. And then for investments held for 30 years or more, the basis step up will be frozen at the fair market value on the 30th year. So instead of having that mandatory sell off like we do currently, they're just going to say after 30 years, you're going to hit whatever that fair market value is, and that's going to be your basis, and any future appreciation is going to be taxable. So this is something to consider when you're looking at the various options you have of potentially, buying or purchasing new property and developing manufacturing facilities. That is a U.S. wide program, but the states determine the official locations. I believe the states will. I think they said July. They will have July of 2026. They will have the locations determined or plotted for us at that point in time. The other item, when you think about today, what did we look at? Well, we looked at taxes, understood, but we're trying to say what's going on in the manufacturing industry. So, finding good people, employing people, that overtime compensation issue is going to be important for them, right? So that's important. We know, obviously, the ability to, as we pointed out multiple times throughout today, the ability to take deductions more quickly than we have in the past, right? To reduce our tax liability so we can invest in our manufacturing process. But I'd be regret to you if I didn't bring up tariffs and all the changes that have been happening with tariffs. We have a whole group within Withum who's doing a fantastic job of monitoring a variety of what's going on here. As you all know, the Supreme Court overturned the tariff policy under Trump. He obviously reinstated it under a different law, but what that means is for anybody who pay tariffs under the Trump policy, there is ability to get a refund for those tariffs. So on the left-hand side, we're going to talk about that first. So how do you prepare for IEEPA tariff refunds? So we're talking about 7 steps, and the first step is really yours. And then essentially the next 6 steps are driven by the CBP. So essentially, if you think you were susceptible to IEEPA tariffs, you would like to request a refund, your first step is to file a declaration in ACE with a list of entries on which IEEPA duties were paid. And once you do that, right, and this recently came out, I want to say as of Friday or late last week, the ACE will run a series of validations on each entry and recalculate the duty owed, so making sure they agree. They'll verify the declaration and process the refund as soon as practical. The ACE will automatically finalize entries, aggregate the funds with interest by the importer and liquidation date, certify the refunds, and then eventually the Department of Treasury will issue the refunds electronically. So if you know that you were assessed that tariff and you're not quite sure how to go about this process, please reach out. While we thought maybe the Supreme Court ruling would say, okay, we're past assessing or increasing of tariffs, we are not, as we know. 122 and 232 sections are still in play, but there are mitigation strategies that we've been helping our clients with to decrease future tariffs. I'm going to just talk about a few. The one I like to really highlight is the unbundling. So removing non-product costs from customer value. So previously before, right, if you weren't paying the tariff, you didn't really care what was in the cost of that product, right? Essentially because it was assessed to 0% amount. And you might have even saw, if you're international, some people putting more into that cost amount because of calculations of GILTI. But it really does make sense that if you're, having marketing or royalty or services included in that amount, we need to do our best job to remove them so that the actual tariff is assessed on the true value and not the non-product cost. So that's something to be aware of. Supply chain and transfer pricing optimization. Aligning how the goods physically move with how they're priced between related parties is really important. Obviously, transfer pricing is important for a variety of reasons, especially from an income tax perspective, but it also is very important with mitigating tariffs. The other item I would also point out is, this might have not been as an accurate digital system, right, up to snuff, like many other things you're doing in your company. This might be time that you're saying we need real time data. We need to be able to move swiftly, right, for changes that we're seeing. And so we might need to modernize how our invoice process is going. And so those are some of the ones that I would highlight are low hanging fruit, in my opinion, to try to deal with mitigation efforts for 122 and 232 tariffs. So I think it's 11:56, so we're right on time. Are there any questions from the group? Okay. I had a great time presenting with you all today. I would say please don't hesitate to reach out. We're happy to have follow-up questions and answers. As you know, I mean, the one thing I think we keep learning, or I keep learning, I should say, every day is change is inevitable. I do think that for purposes of tax legislation, people have definitely identified it as something that will change depending on new administrations. So while we, I think, currently feel comfortable, obviously, that we have a 3-year timeline coming. I would expect tax changes to be another top debate item. It's not only a debate item at the federal level, we're also seeing it at the state level. We're seeing a lot of states pop up and start talking about wealth tax. So there's a lot of activity out there. If you are, and I know it's the last thing, but I always plug this. If you are a pass-through entity and you are a shareholder or partner, really taking advantage of our estate tax exemption amounts and planning opportunities that exist today, and looking at your total tax structure, because obviously that is a heated debate of whether that estate tax gift exemption is too high. And we need to make sure that we're utilizing it appropriately before it's too late. So I'm going to wrap up there, Joe. Is there anything you would like to add?
Awesome. So if there's no more questions, I'd like to thank everyone for joining us today, and a big thank you to Lynn and the Withum team for making this information session possible. Staying up to date in discussions like this is key for keeping our manufacturers in our state informed as these regulations evolve. As always, keep an eye out for more affiliate webinars in the future. And just a reminder, this recording, as well as Lynn's contact information, will be sent out to every single person who registered. So I hope everyone has a great day, and thank you for joining.
Thanks, everyone.
Mhm.